What's up everybody, GenExDividendInvestor here. If you're new to my channel, then welcome. I'm in my 40s and am a self-made multimillionaire who's been investing in the markets for over 25 years. I tell you that not to flex over the internet, which I find immature, but instead to give you some context to my history. I'm not someone who inherited a dime or won a lottery. I'm someone who started at less than zero due to student loans and then worked to increase my net worth for over 25 years of investing. Watch my How to Become a Millionaire video if you want to learn how I made my money, and which shows you how you can as well. Or watch the time I sold all my stocks video if you want to hear valuable investing lessons from the most life-changing experience of my life. The goal of my channel is to inspire, educate, and entertain you with valuable investing insights as I review my $1 million dividend portfolio, as well as a slew of other valuable content. In this video, I'll be answering questions that were sent to me on Instagram by my subscribers. If you'd like to potentially be featured in my next Millionaire Dividend Investing Questions and Answers video, then follow me on Instagram at GenExDividendInvestor and send me your questions. Then I'll end this video with a cautionary tale of a Robinhood stock trader who got so addicted to trading that he maxed out credit cards and even took out home equity loans to get more money so that he could trade in speculative stocks and options. So please do me a favor and like this video as a simple way you can thank me for making it. And consider subscribing and clicking the bell notification. Finally, I'm not a financial advisor, so take my responses as entertainment only, not as a way to make financial decisions. The first questions come from Guy in the 415. I blacked out the first part of his name. He asked me 3 questions, so I'll answer one by one. First is, are you still contributing to your portfolio or letting it run on its own now? So I'm letting my dividend portfolio run on its own. I'm happy at the pace it's going and I'm investing my cash outside of it. My DRIP is contributing about $1,000 a week on average, so I'm cool with that. His next question is, what's the goal for the future for retirement? So right now I'm trying to convince my wife we should move to Europe, Central America, or Asia and live off our dividends. She has less confidence in the security of doing that, and she feels we should be doing normal 9-to-5 jobs while we're still in our 40s, i.e. the prime of our earning years. I feel differently, but want her to be on board before we do anything too drastic. She currently has a 9-to-5 hourly job, and I'm currently working with a startup for equity. So stay tuned. I'll tell you guys if we ever decide to do something fun and move somewhere crazy. Either way, I plan to keep building my YouTube channel because I love doing it. Next, he asked, do you have a particular number that you would want to drip a year? Well, I had a goal of 50K with a conservative average weighted dividend yield for a long time, and now I'm enjoying that I finally hit that goal. I think the next big goal would be 100K a year at around a 3% average weighted yield, with lots of little milestones along the way. Of course, I could just move into riskier positions that have a 10% yield and voila, my income would be at 170K per year, but that wouldn't be a prudent investing decision, so I invest in companies that will let me sleep well at night. The next question comes from Elm. He said, hey GenX, I have a question about knowing when to sell or hold until a better time to sell. I bought 10 shares of 2 M REITs, AGNC and NRZ. A couple of my first purchases when I started investing last year and didn't fully understand these investments. Both stocks have dropped and are recently ticking upwards ever so slightly. But I'm down 25% in AGNC and 48% in NRZ. I don't know that I want to hold them long term. Do I take the losses now and sell while I can? Wait until they get closer to my cost basis, hoping they don't drop further? Thanks for putting out great content. And I'd reinvest in something more long term and stable like Coke or another stock I'm planning to hold long term. So that's a good question. I actually did a video called When to Sell a Stock, which gives my nuanced perspective on selling. So unfortunately I can't answer that for you. It sounds like you made some purchases you aren't fond of and now you want to get out. It depends on so many factors, from your risk tolerance, to your patience, to your lack of confidence in these positions, to your confidence in the positions you want to move into, etc. Your state of mind is important too. Are you losing sleep over it? Is it grating on your nerves? So if it's a relatively small amount, then making the move into something you want to be in might be worth doing that from a happiness and stress perspective, even if the price feels a tad higher than you would like it to be. Sometimes people hold on to things that trend down and then sell things that are trending up, which is the exact opposite of what you want to do. So I don't fault someone for doing that, as you can't predict the future. Bottom line, if you think you've gotten to something that is weak, then you're saying that there are better investments out there for your money, right? I personally prefer stocks that let me sleep well at night, so if it were me, I'd be in positions that I had confidence in, and if I wasn't in them, then I'd move into them. Do your DCF and figure out where you are comfortable entering into your new positions. Then move into them when you feel the time makes sense for your financial situation. And then don't look back. No regrets. Just move forward and learn. Okay, the next question comes from Mark. He said, thank you for answering. My questions were as follows. Have you had any experience with the broker trading 212 or DeGiro? And as a beginner, is it fine if I invest in companies with a high dividend yield, or should I invest in companies that have more growth potential? Would love to hear some feedback. Kind regards, Mark. Thanks, Mark. So I don't have any personal experience with those, but I did do a video called Best Brokers in 2020, and I talked about them. It seems that trading 212 has lots of fans, and DeGiro has some new innovative concepts that are worth exploring. In terms of should you invest in high dividend yield, or should you invest in companies that have more growth potential? If my kids asked me that, I would say go with quality that has growth potential. However, if you are retiring soon, then complementing your growth with some yield can make sense. When yields get over 7 or 8%, I start getting nervous, and I don't think I'd ever look seriously at most 10% plus dividend yield stocks. I've seen way too many people get burned way too many times going after insane yields. Okay, the next one comes from Nicholas. He asks, how do you decide where to put your money when you've got some extra to invest? So I take a variety of things into consideration. For example, I have enough stocks that normally I'll have a few that seem like reasonable prices, and good prices usually weigh into my decision making. I also like to look at the size of my positions, and sometimes I like to push them in certain directions. So am I too heavy in tech or too light in industrials or whatever? So that also influences what I invest in. Sometimes I feel very bullish about a stock's growth potential, so that's another input into making a decision. Then my various financial goals influence what I might invest in. For example, if I'm getting ready to retire and I want more income, then I might invest in stocks that have the right profile of dividend metrics I desire. I basically like to analyze my current positions and my watchlist positions, and then make a determination based on my goals and what makes sense to me at the time. Okay, the next question comes from Orlando. He said, Gen X, given the current financial crisis most of us are experiencing, it seems like most financial YouTubers are talking about potential crash. I would love to hear your take on this matter. Would you do a video voicing your opinion? So in terms of do I think there's a crash? Honestly, I have no idea. I think a crash is a very real possibility, but we could also avoid the crash. And I'm just fine letting my investments ride as I'm confident in their long-term potentials and can deal with the volatility. My mindset is able to deal with my portfolio dropping 50% from where it is. I wouldn't be inclined to sell. I'm also ready for my investments to go sideways for a decade, and I won't complain or be inclined to sell. Okay, I won't complain too much. Like I said, at its core, investing is rather simple. You primarily just keep investing in quality. That's it. Okay, the next question comes from Primo. He said, what are your thoughts on some stocks that are either halting their dividends or lowering their dividends due to the pandemic? Would you buy more or stop and sell the stock? Later on in the years, the dividends could come back to normal. Is this the long term and just hold? Thanks, Primo. As most things, it depends. If I really believe in a company, then I'm not worried what they do in the short term because of this extremely rare pandemic. For example, if McDonald's had to cut their dividend for a while, I wouldn't sell. Disney's another great example. I'm still a long-term Disney bull, so I'm not worried that they suspended their dividend. Now, if a company that I'm not super fond of cut their dividend, then I might reconsider things. An example is oil. I feel those are some of my riskiest positions in my portfolio, and I've never really been overly enamored with oil. Do I think oil will rebound and will make it past the current oil war and pandemic? Yes. But since I don't love it, I'll make a decision based on what happens and where I am. Okay, the next question comes from Sam. Your last video was very good. Thank you and keep making more. What's your take on Wells Fargo after the dividend cut? I have about 75 shares in them and was wondering if it's time to switch to a better paying dividend stock. Thanks, Sam. Regarding Wells Fargo, I think that dividend cut is rough. I'm actually a Wells Fargo customer, but I've been put off by some of their recent shady business practices I've heard about. I'm not really a big fan of banks, given we need to bail them out. That doesn't mean you can't make money on them. I just like businesses to survive on their own without government intervention. I personally went into Goldman Sachs more as a capital appreciation play, but then they started getting aggressive with their dividend increase, so I'm going to wait and see with that one. So I'm obviously not a fan of a massive dividend cut like that. I personally would look at banks that have at least 10 consecutive years of dividend growth as one of the core metrics I care about. So I'm also not saying I wouldn't jump into a bank at some point. Okay, the next question comes from Sending Freedom, who said, what are your thoughts on Albertsons, now that they are public? He said, Albertsons looks very attractive at its current price point. I was able to lock in shares under $14 a share. It could potentially move much higher. I appreciate your thoughts and words of wisdom. Well, thanks for the compliment, Sending Freedom. So I tend not to invest in brand new IPOs unless it's a company I really understand and believe in. So supermarkets don't fit something I have an extensive background in, whereas technology I do. So I really couldn't comment anything intelligent about investing in a food company that just IPO'd. That being said, I think food seems to be a nice recession-proof stock category, and they are aligned to that. Okay, the next questions come from a good friend and longtime subscriber, Stoian. He said, Hi Gen X, very good video, thank you. Would you reveal which companies are in the top 15 on your watch list? So I may do that at some point, Stoian. I'd need to think of a fun way to do that first. I don't have the time in my schedule anymore for hour-long in-depth videos, so I'm not sure how I would reveal them. But if anyone has any suggestions on a fun way I could, please leave a comment down below with your thoughts. Thanks. Okay, the next question comes from Tango. He said, do you think companies such as Google or Amazon will reach a point that they pay dividends? Google especially, given their cash balance. I think eventually if the companies persist, which I bet Google and Amazon will, at some point their growth will stagnate for a while, and that's probably when they will look at something like dividends to continue to attract investors and return money back to them. Obviously right now it's smarter for them to drive their money into growth. Take Amazon. Bezos is going into various industries and it's dominating right now. They are top tier players in both cloud and e-commerce and are huge players in others. All that takes money, so who knows if or when we'll see Google or them pay dividends. So sometimes whether a company will pay dividends is based on the influence of the CEO. So Steve Jobs wasn't into dividends, but then Tim Cook has been open to them. Okay, the next question comes from Think Money, who has a YouTube channel you should check out. He said, at what point in terms of portfolio cash balance did you notice the ball really start to get rolling? Obviously, the higher the balance, the faster the dividends start compounding. But do you recall a specific cash balance where you had, this is what I'm talking about moment? I think by cash balance you mean total portfolio value. So speaking of total portfolio value, I've always valued total portfolio value significantly, as it gives you optionality to turn it into income generating or into cash or whatever. So I think it's a mistake when someone says they only care about their dividend income and not their total portfolio value. So for example, you can find crazy investments with 50% yield right now, believe it or not. So if someone said they had $50,000 a year of dividend income, that might sound awesome, but then if you found their total portfolio value is $100K, you'd then realize that just stating your dividend income without also stating your average weighted portfolio yield or your total portfolio value is almost a useless data point. So only focusing on your dividend income is not smart. However, your dividend income relative to your total portfolio value is something that is more insightful. So back to your question. I honestly didn't feel like my dividend portfolio was awesome until I crossed the 1 million total portfolio value mark, and again when I hit 50K in income 4 months ago at a portfolio value of 1.46 million. Now my portfolio value has rocketed up to about 1.7 million, as even with the low beta this market has been on a tear. Okay, the next question comes from Vincent. He said, "Hi Gen X, why would you tell your kids to get VTI or VU and not individual stocks?" So while I recommend ETFs to everyone, my kids still personally prefer single stocks too. They like to hold McDonald's because they feel like they own it. I've talked to my kids about holding ETFs, but I've let them make the ultimate decision on what they want to do with their money, and they prefer single stocks. I ask them to put 50% of any money they get from birthday presents or chores or whatever into stocks. I'm big on letting them make the decisions on their custodial accounts, and I'm just there to be a safety net override if they do something which I think doesn't make sense. So while I think VTI and VU would be great for them, I'm not overriding their voice of wanting to go with individual stocks. But to be clear, I think it's smarter for the average investor to simply hold an inexpensive broad market ETF and then consistently invest what they can afford. I think you have less of a tendency to sell if something goes south, and it's a mindlessly easy and fast way to invest, which makes it ideal for the majority of folks. Now I'm going to tell you about Richard Dobetzi, a Robinhood stock trader who got so addicted into trading that he maxed out credit cards and even took out home equity loans to get more money so he could trade in speculative stocks and options. Richard is a Navy medic and he liked Robinhood's simple user interface, which also had fun things like falling confetti and emoji notifications, which made investing feel like a game to him. But he made poor investment choices such as using leverage to invest, as well as to invest in speculative stocks and options. He got so addicted to day trading that he couldn't pull himself away from the market, even to eat food. So what happened? Well, as you could guess, it took him only a few months to lose almost all his money, and apparently now he's planning to appeal his case to financial regulators for arbitration against Robinhood. Almost everyone who gets into day trading or speculative stocks or penny stocks loses money. It's almost a surefire way to lose, even though it might seem like a get-rich-quick scheme. It's actually a get-poor-quick scheme for the majority of people. Don't listen to the probably fake one-off story you hear about someone making it rich and taking that as the norm. Remember, the majority of people who invest in the market get 2% returns on average, precisely because they make poor investing decisions because they are looking to get rich fast. So what can we learn from Richard? Number 1, don't use leverage. By that I mean don't use any debt or credit to invest in stocks. Even if it's offered, just invest the cash you already have that you can afford to lose after you have an emergency fund established. Number 2, don't treat investing as a game, even if the interface makes it feel that way to you. It's hard to make money to invest, and it's easy to lose it. Approach investing seriously. Number 3, don't invest any material amount of your investment dollars in speculative things. Invest in quality. So many people try for the quick buck, and you only hear stories about the minority of people who make money, not the majority who lose. Penny stocks and speculative stocks are usually terrible ways for the majority of people to invest. Ignore the hype on media pushing bad ways to use your money. Number 4, don't day trade. According to the stock platform eToro, an insane 80% of day traders lose money over the course of the year, and with a median loss of over 36%. And they said that more than 75% of all day traders end up quitting within just 2 years. So instead, consistently invest whatever money you can afford to lose in quality companies, and over the long run you should come out great. Thank you so much for watching. I'd really appreciate it if you'd left a like on this video, and I highly recommend that you join my free Dividend Discord chat server, which is the largest in the world, and the last time I checked we had over 4,300 Dividend investors on it, and it's growing all the time. The link is in the description below if you'd like to join. Remember to click the heart emoji to get authorized once you sign in, or you can wait for me to manually authorize you. By the way, if you'd like to ask me a question and potentially be highlighted in my next Millionaire Dividend Investor questions and answer video, then follow me on Instagram and DM me your question. Finally, I want to leave you with this quote. 2 roads diverged in a wood, and I took the one less traveled, and that has made all the difference. Robert Frost. Thanks, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.